Welcome back to the Deep Dive. Today, we're digging into a fascinating earnings report you, our listener, provided us with. It's for Innodata, Inc., ticker INOD, specifically their Q3 2025 results.
And you've given us a great roadmap. It's a really structured five-part financial analysis. We're going to follow that closely.
Right, because the goal today isn't just reading numbers. We want to get behind those, sometimes misleading headlines.
Exactly. We're using this framework you provided to really understand Innodata's operations, their financial health, and crucially for a stock like this, what their future looks like. And just to be clear, we'll announce each section as we go, just like in the source material you sent over.
Okay, and we have to start with the big puzzle here. The stock, INOD, it jumped. What was it, over 10% right after the earnings came out?
A huge jump, yeah, 10.76% to be precise.
But, and this is the crazy part, the report showed their official earnings per share actually collapsed, like down 52.9% compared to last year. That seems wrong.
It seems completely counterintuitive, doesn't it? A profit crash usually sends a stock tumbling, but the market reacted positively. That's the knot we really need to untangle today.
It sounds like a classic case of needing to look beyond the surface numbers.
Absolutely. It's a perfect example of why financial literacy matters. You can't just take that GAAP EPS at face value. Sophisticated investors, well, they saw through it pretty quickly.
Okay, so let's show everyone how they did that. Let's start untangling. Okay, let's unpack this with slide 1, the at-a-glance scorecard. So first up, the top line. Revenue looks pretty good, actually.
It does. The report shows total revenue hit $62.6 million for Q3 2025.
And compared to last year?
That's up 20.0%, a solid increase from the $52.2 million they did in Q3 of 2024. So yeah, good top-line growth.
Okay, 20% growth sounds great, but then we hit that profitability line you mentioned.
And this is where, you get that initial shock if you're just scanning headlines. The official GAAP net income, that's the profit for common shareholders, it dropped sharply, 52.3% down.
Wow, from what to what?
It fell to $8.3 million from $17.4 million in the same quarter last year.
And that flows straight down to the per share number, right?
Exactly, which gives us that dramatic diluted EPS collapse we talked about. It fell 52.9%, going from 51 cents a share last year down to just $0.24 this quarter.
Okay, so just looking at that year-over-year comparison, that 52.9% drop, it looks terrible. Makes the stock rally seem totally irrational.
On the surface, absolutely. If you stopped right there, you'd be scratching your head or maybe selling the stock.
But this is where the story flips, isn't it? Because the market isn't just looking backward. It's about expectations.
Precisely. The market trades on surprise. How did the company do compared to what Wall Street expected them to do? That's the key.
So how did they stack up against those expectations?
Well, this is where Innodata delivered. They beat expectations on both revenue and earnings per share. The market had already priced in some, let's say, complexities.
This is a revenue number.
Yeah.
$62.6 million.
That beat the Wall Street consensus estimate, which was around $59.79 million. So better than expected on sales, suggesting the business momentum is actually strong.
And the EPS. That's the big one. Given the year-over-year drop, they reported $0.24.
And the analysts were only expecting $0.20, so they didn't just squeak by. They crushed the estimate by a massive 71%.
71%. Okay, now I see why the market might ignore the ugly year-over-year number. That's a huge beat.
It's a massive positive surprise, and for smart investors, that instantly outweighs that misleading historical comparison. Now, we need to understand why that comparison was so misleading.
Right. You said there were two main reasons the 52.9% drop wasn't really about the current business failing.
Exactly. Reason number one, and it's the biggest factor, is a tax anomaly. It involves something called net operating loss carryforwards, or NOLCOs.
Okay, NOLCOs. Let's break that down simply. What are they and how do they affect Innodata here?
So think of NOLCOs like this. If a company loses money for several years, the tax code lets them save up those losses. Then, when they finally start making good profits, they can use those saved up losses, like a big coupon, to wipe out or drastically reduce their current tax bill.
Ah, okay. So it's a benefit from past losses that hits the books when they become profitable.
Precisely. And Innodata hit that point back in Q3 of 2024. That $1.51 EPS number they reported last year, the analysis shows about $0.27 of that, more than half, wasn't from selling services. It was purely from cashing in that NOLCO tax coupon. It was a one-time non-cash benefit.
So wait, if you strip out that $1.27 tax benefit from last year's $1.51,
you get an operational EPS last year that was actually closer to 24 cents.
Which is exactly what they reported this quarter.
Exactly. So that 52.9% drop, it wasn't an operational collapse. It was just, well, a mathematical distortion because last year's number was artificially inflated by that huge one-off tax benefit. Once that benefit was gone in Q3 2025, the comparison looked terrible, but the underlying operational profit was basically flat to slightly up, adjusted for taxes. The market understood this.
Okay, that makes a huge difference. That explains most of it. What was the second reason you mentioned? Something about dilution.
Right, the second factor is share dilution. It explains why the EPS fell slightly faster than the net income itself.
Can you remind us what dilution means in this context, especially for a growth company?
Sure. We usually focus on diluted EPS, which assumes all stock options and similar things are converted into shares. It's the more conservative number. Growth companies like Innodata often use stock options heavily to attract and keep talent, especially in tech. They pay people partly in potential future ownership instead of just cash.
So they're using stock as currency, basically.
Exactly. It saves cash, which is crucial for growth, but it means that over time, the total number of shares outstanding increases. The profit pie gets divided into slightly more slices.
And that happened here.
Yep. The weighted average diluted share count went up from about 34 million shares in Q3 24 to over 35.2 million in Q3 25. It's not a huge increase, but it adds a bit of downward pressure on the per-share earnings number.
So more shares dividing up the profit makes the EPS figure drop a bit faster.
Correct. It just compounds the effect when you compare it to that artificially high starting point from last year.
Okay, so putting slide one together, the market saw the big revenue beat, the huge EPS beat versus estimates, understood the $1.51 last year was inflated by taxes, factored in the minor dilution, and basically ignored the scary 52.9% gap drop.
That's the takeaway. Sophisticated investors filtered out the noise. They saw the operational strength shining through the accounting distortions. They bought the beat and the underlying story, not the misleading historical gap comparison.
So we've debunked a gap number. Now we need to find a better measure of their actual operational profitability.
Exactly, which takes us right into the next part of the analysis. Moving to slide 2, the engine of profitability. So given how misleading that gap net income number was, we absolutely have to shift gears. We need a metric that shows us the real earning power of the core business, and that metric is adjusted EBITDA.
Right, EBITDA. Earnings before interest, taxes, depreciation, and amortization. We hear that term a lot. Why is it the right tool for Innodata right now?
Because it acts as a proxy for cash profit generated just from running the main business. And critically, for this analysis, it strips out exactly the things that distorted the gap picture: interest payments, depreciation, which is a non-cash charge, and most importantly, those weird tax rate issues caused by the NLCOs.
So EBITDA gives us a clearer view of just how well are they doing at their core job of providing AI services.
That's the idea. It isolates the operational performance. And when we look at Innodata's adjusted EBITDA, the story completely flips from that gap number.
Okay, so the GAAP net income fell 52.3%. What did adjusted EBITDA do?
Adjusted EBITDA grew, and grew nicely by 16.5% year over year.
Wow, okay. From down 52% to up 16.5%. That's a massive difference. What were the actual numbers?
Adjusted EBITDA came in at $16.2 million for Q3 2025. That's up from $13.9 million in Q3 2024.
So this confirms it then. The underlying business is getting more profitable operationally, despite what the gap numbers suggested. The gap drop was definitely an illusion.
It's the single most important confirmation in this section. The core business is healthy and growing its operational earnings.
Okay, so the amount of profit is growing. But what about efficiency? Did they get better at converting that $62.6 million in revenue into profit?
Yeah.
You need to look at the margins, right? The percentage they keep.
Right, and this is where we see a bit of nuance. The adjusted EBITDA margin actually dipped slightly.
Oh, how much?
It went from 26.6% in Q3 last year down to 25.9% this quarter, so a small decline.
So let me get this straight. Revenue grew 20%, but this operational profit, EBITDA, only grew 16.5%.
Yeah.
That means costs must have grown a little bit faster than revenue, causing the margin to shrink slightly.
That's exactly what it means. On its own, you'd normally prefer to see margins holding steady or even expanding as revenue grows. A contraction can sometimes be a warning sign.
But you said there's nuance here.
Yes, because management specifically addressed this. They framed it not as a negative, but as a deliberate strategic choice. They call it their investing for growth profile. Meaning they're intentionally taking some of those growing profits and reinvesting them heavily back into the business right now, even if it temporarily squeezes margins a bit.
Investing in what specifically?
They mentioned 7 major investment areas, likely things like R&D, sales capacity, new tech platforms, and specifically called out the big launch of Innodata Federal. That's their new division targeting government contracts.
Ah, okay. So those things cost money up front. Hiring people, getting certifications, building relationships before they generate significant revenue.
Precisely. They're accepting slightly lower margins today because they believe these investments will drive much larger, transformative growth, as they put it, starting in 2026. They're sacrificing a little bit of profit percentage now for a much bigger pie later.
That makes sense strategically, assuming the growth actually materializes. It's a bet on future execution.
It is. And we'll see later when we look at their pipeline why they might feel confident making that bet. But for now, the takeaway from slide 2 is ignore the gap drop. Focus on the healthy 16.5% growth in real operational profit, adjusted EBITDA, and understand the slight margin dip is a calculated investment, not necessarily a sign of trouble.
Got it. So the overall engine is running well, even if they're tuning it for future speed over current fuel efficiency. Now let's look inside that engine. Which parts are really driving things? Now for slide 3, the engine room business segment performance. Okay, so Innodata isn't just one monolithic thing. The analysis breaks it down into 3 business segments, right?
That's right. There's Digital Data Solutions, or DDS, that's the big one, focused on AI services. Then there's Synodex and Agility. Looking at these segments really tells the story of where the company's focus and, frankly, its future lies.
The analysis says it's basically all about one segment.
Overwhelmingly, yes.
Right.
Innodata today is essentially a pure play bet on that DDS segment. It's not really a diversified company anymore, operationally speaking.
Let's see the numbers. How much the total revenue comes from DDS?
In Q3 2025, DDS brought in nearly $55 million. That accounts for a huge GRH, 87.5% of the company's total $62.6 million revenue.
87.5%. Wow. And is that segment growing?
It is, and faster than the company average. DDS revenue grew 22.6% year over year, so the biggest part of the company is also the fastest growing part.
What about the other two? Synodex and Agility, what do they even do quickly, and how are they performing?
So Synodex has traditionally been focused on data transformation for regulated industries, maybe older, complex stuff. Agility is more around business process support, but financially they're becoming less and less significant.
How much revenue do they represent?
Together, only about 12.5% of the total revenue now, and their performance is mixed to negative. Synodex revenue actually declined by 14.6% this quarter. Agility did grow about 9.3%, but its overall contribution is pretty small compared to DDS.
Okay, so revenue-wise, it's clearly the DDS show. 87.5% of the pie and growing fast. But what about profit? Is DDS also carrying the load there?
Oh, even more so. The profit story is actually starker. It shows exactly where management is placing its bets.
How did DDS do on profitability using that adjusted EBITDA measure?
DDS adjusted EBITDA grew by a very strong 25.9% year over year. It generated over $15.2 million in operational profit this quarter, up from about $12.1 million last year. So it added over $3.1 million in profit compared to Q3 24.
Okay, strong profit growth from the main engine. What about Synodex and Agility's profits?
This is the critical point. Their profitability absolutely collapsed. Synodex's adjusted EBITDA dropped by almost 75%, or 74.6% to be exact, and Agility's profit fell nearly 31%.
Wow. So while DDS profit was surging, the other two segments saw their profits crater.
Precisely. And here's the key insight from the analysis. The entire company's consolidated operational profit growth, that $2.3 million increase in adjusted EBITDA we saw on slide 2, came solely from the DDS segment.
Wait, so DDS didn't just have to grow its own profit?
It had to grow enough to completely offset the profit declines from both Synodex and Agility, just to get the overall company's profit growth up to that 16.5% level.
That's incredible. It means DDS is literally carrying the entire company's profit growth on its shoulders.
It absolutely is, which tells you exactly why management is focusing all those investments. The 7 major areas, the federal push, the sovereign AI talk squarely on DDS. They know where the value is being created.
So the conclusion here is pretty clear then. If you're investing in INOD,
you're making a concentrated pure play bet on the AI-driven DDS segment, period. You have to believe that segment will keep firing on all cylinders because the rest of the company is, frankly, becoming almost irrelevant to the growth story. It validates management's focus completely.
Makes sense. If one engine is providing all the thrust, you pour fuel into that engine.
Yeah.
Okay, so the core business is strong, focused, and growing profit.
Mm.
But can they sustain this? Let's look at their financial foundation.
Right. A growth story is great, but you need the financial strength to back it up. Which brings us to our next section. Moving to slide 4, financial strength and shareholder rewards. So we've seen the DDS engine is working. Now let's check the chassis, the foundation, the balance sheet. Is the company financially sound enough to support this aggressive growth plan?
Yeah, sometimes growth stocks get ahead of themselves, take on too much debt. How does Innodata look?
Actually, they look exceptionally strong. The analysis calls it almost fortress-like, which is quite a statement.
Okay, let's test that. First, short-term health. Can they pay their bills coming due soon? We look at the current ratio for that, right? Current assets divided by current liabilities.
Correct. And you want that ratio to be comfortably above 1.0. Innodata's is, well, it's 2.69.
2.69, that's very high. So they have almost $2.70 in short-term assets for every $1 in short-term debt.
Exactly. It signals extremely strong liquidity. Now, sometimes, as you hinted, a ratio that high might mean they're sitting on too much cash inefficiently.
Is that the case here, or is there a reason for it?
Given their strategy investing heavily, targeting big projects like Innodata Federal and that huge pipeline we'll get to this high ratio looks more like strategic preparedness.
Yeah.
They've built up reserves so they can fund these big moves without having to suddenly raise money in potentially bad market conditions. It gives them flexibility.
Okay, that makes sense.
Yeah.
What about longer-term stability? Solvency.
This is probably the most striking data point on the balance sheet. Their cash balance, just the cash they have sitting in the bank, is $73.9 million.
Okay, and their total debt.
Their total liabilities, including everything, short-term and long-term, is only $55.7 million.
Wait, so their cash on hand is more than all their debt combined?
Significantly more. They could theoretically pay off every single liability they have tomorrow using only cash and still have over $18 million left over. That's what we mean by fortress balance sheet. Very rare for a high-growth company.
That implies very low debt or leverage then.
Extremely low. The liabilities to equity ratio is just 0.57, which tells you their growth isn't being funded by borrowing heavily. It's funded mainly by the cash the business generates and by issuing equity, like those stock options we discussed. Low debt means less risk and more freedom to act strategically.
Okay, so financially, they're incredibly solid. Which brings up the question, what are they doing with all this financial strength for shareholders now? Dividends, buybacks.
Oh, well, this confirms their identity as a pure growth stock. If you look at their cash flow statement under financing activities.
Let me guess. 0 dividends paid.
0. And $0 spent on repurchase of common stock or buybacks. They are keeping 100% of the cash generated and plowing it straight back into the business, primarily that DDS segment.
So no immediate cash returns for shareholders. The reward is supposed to come from future stock price appreciation driven by that reinvested growth.
That's the growth stock model, yes. And instead of using cash to reward people, they use stock options, which, as we saw, actually brings little cash in when exercised, $1.5 million in this case. But it does dilute existing shareholders slightly over time. It's the complete opposite of a mature value stock that might prioritize buybacks and dividends.
Okay, so a super strong balance sheet is fueling reinvestment in the high-growth AI engine, with the payoff expected down the road, which leads us perfectly into the final section. What exactly is that road ahead?
Let's look at what management is telling us.
Finally, slide 5, the road ahead management's outlook and key takeaways. This is where management sells the future story, right? And it sounds like they came out pretty confident.
Extremely confident, and crucially, they backed it up with numbers, not just vague optimism.
So first, looking at the rest of this year, 2025, did they stick to their previous guidance?
They did. They strongly reiterated their full-year target of 45% or more year-over-year organic revenue growth, hitting Q3 strongly, and then reaffirming such a high target for the full year basically tells the market, we've got this handled for 2025.
Okay, confidence for the current year. But the commentary really shifted focus, didn't it?
Absolutely. The narrative pivoted very clearly towards 2026, forecasting a continuation of our transformative growth.
Transformative growth sounds like standard CEO speak. Did they provide anything concrete to back that up?
They did, and this is probably the single most important part of the release for investors trying to look forward. They didn't just promise growth, they quantified a massive pipeline of new business.
A massive.
$99.5 million worth of specific business opportunities that they described as either signed or likely to be signed soon.
Wow, nearly $100 million. Let's put that in context. Their current quarterly revenue is about $62.6 million. Annualized, that's roughly $250 million. So this pipeline alone represents a potential what, almost 40% increase on top of their already high 2025 growth?
Exactly. It shows the scale of the deals they're now competing for and winning. It
Yeah.
makes that transformative growth talk feel much more credible. It's not just hope. It's based on tangible, large dollar projects.
And they broke down where that $99.5 million is coming from.
Yes, into three key areas that align with their investment focus. First, their core area, pre-training data for AI models. They see $68 million in potential revenue there. That shows continued strong demand for their main service.
Okay, $68 million in the core business. What else?
Second, that new Innodata federal practice. They highlighted a specific new federal customer project expected to bring in $25 million, with most of that hitting in 2026.
That's a big win for a new division, and federal contracts can be sticky, right?
Often, yes, they can be harder to win initially, but provide longer-term, stable revenue streams, often at good margins. So that $25 million validates the investment in that area.
And the last piece of the pipeline?
A new deal signed with another major big tech firm, valued at $6.5 million in annualized revenue run rate. Expanding relationships with these huge tech players is obviously key.
So you add up the $68 million, the $25 million, the $6.5 million. That's your $99.5 million pipeline. Specific, large numbers tied to their strategic initiatives. That does paint a compelling picture for 2026.
It really does. Providing that level of quantified detail instead of just saying we're optimistic gives the market something solid to latch onto. It suggests the investments are already paying off in terms of securing future business.
Okay, so let's wrap this all up. Based on these 5 slides, what are the absolute key takeaways an investor should have gotten from this Innodata report?
I think there are 4 critical conclusions that emerge from the structured analysis. First, the market beat was real and significant. They beat revenue estimates and absolutely crushed EPS estimates, validating strong current demand.
Second, the GAAP earnings drop was a tax solution. You had to look past it. The real operational profit, adjusted EBITDA, grew a healthy 16.5%.
Third, Innodata is now effectively a pure-play AI company. The DDS segment is driving almost all the revenue and all the profit growth. The investment thesis rests entirely on that segment's continued success.
And fourth, they have a fortress balance sheet. That incredible financial strength isn't just sitting there, it's actively funding the invest for growth strategy and makes that huge $99.5 million pipeline for 2026 seem achievable and fully funded.
So the final narrative explaining why the stock rallied is this. Q3 marked the point where Innodata's identity shifted decisively in the market's eyes. It fully decoupled from that misleading GAAP history tied to the tax benefit.
Market decoded the story, as you said earlier.
Exactly. Investors looked past the GAAP noise, saw the real operational growth in the AI segment, saw the financial strength, and crucially, they saw management lay out a specific, credible, multi-million-dollar path to continued high growth in 2026 via that pipeline. That combination validated the whole transformative growth story.
It really shows how valuable digging deep with a consistent framework can be. If you just read the headline, EPS drop, you'd have gotten a completely wrong idea. Understanding the why behind the numbers, especially non-GAAP ones like EBITDA and the forward guidance, was everything here.
Absolutely. GAAP is necessary, but it doesn't always reflect operational reality, especially with one-offs like tax benefits.
Okay, before we wrap up, we need to include the mandatory disclaimers. Please remember, this deep dive is purely for informational purposes. It is not financial, investment, legal, or tax advice. Any investment decisions you make should be based on your own thorough research and after consulting with a qualified financial professional.
And also, remember that the structured analysis guiding our discussion today was generated by an artificial intelligence model. It integrated data from Innodata's official press release and public market data. While it provides a great framework, you should always independently verify any information before relying on it.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.